What's going on, guys? Welcome back to the channel. In this video, I'm going to talk about spousal Roth IRAs, how you can get money into your spouse's Roth IRA even if they don't have earned income themselves. You can actually use the earned income from your own job. So let's go over these spousal Roth IRAs, kind of how they work, what you need to know, and how you can make sure that you don't end up with a surprise tax bill. So the first thing that we want to talk about is the fact that it is a separate account. It is just like a regular Roth IRA. In fact, there is no difference in the titling of the Roth IRA. It's actually a spousal contribution. It's not an actual spousal IRA or Roth IRA. You can even use the same Roth IRA, or even if you're doing traditional, the same account that you might already have from years before. So you can even make those contributions. So the first thing that you need to know about the spousal Roth IRAs is that it is just a regular Roth IRA account. So just opening up the account in your spouse's name, not your own, your spouse's name, and that's it. There's no special thing that you need to do, no special requirement. This is not a separate type of account. It is just an account in your spouse's name. So that's number one. Number two is that it has to be earned income. Now, the earned income is going to come from the spouse that's earning the income. So that has to be there in order to make this contribution. So as long as the math works that you have enough earned income. So for example, and it's probably not a greatest example, let's say that you only earn $6,000 for the year and you put it into your own IRA, well, then there's no money left over. So you can't put it into your spouse's Roth IRA as well. But if you had $12,000 in income, then you could do $6,000 and $6,000. So that's just something to remember or to think about. So the Roth IRA has to be earned income. So now we have it as a separate account. It is earned income, and it's up to $6,000. And if you're 50 or older, you can do an additional $1,000, which is the catch-up contribution. But there is a phase out for this. Now, it is for married filing jointly only. Yeah, that's right. If you're doing filing separately, this is something you can't do, unfortunately. It's just one of those things that you have to file as jointly. So married filing jointly, $6,000, 50 or over, an additional $1,000. And the phase out on this is from $198,000 to $208,000. Now, I'm not going to go into a phase out calculation in this video because I have done a video on phase out. So go ahead and watch that. But at $198,000, you can do the full amount for yourself and your spouse. So if your spouse wants to contribute or you want to contribute into the Roth IRA, 198 or less in adjusted gross income or modified adjusted gross income in this case, then it's up to $6,000. And it starts to phase out. So at $208,000, unfortunately, you can't contribute directly into the Roth IRA. But key word there, directly. There's still a strategy here to make that spousal contribution if you're over that threshold, and that is making a non-deductible contribution. So if you earn over $208,000, you can't contribute directly into the Roth IRA. So here's how that works. We're going to do an illustration. So let's say that you have a Roth IRA here and a traditional IRA here. Now, if your traditional IRA has no money in it and you make the contribution as a non-deductible contribution into your traditional IRA, so let's say that's $6,000, then you can convert it over to a Roth IRA through a Roth conversion. So this is called the Backdoor Roth IRA, where you're making the non-deductible contribution into the traditional IRA, and then you're immediately transferring it over to the Roth IRA. Now, here's where this gets a little hairy. So let's say that you have existing dollars inside of your traditional IRA. Now, I'm doing this as two separate buckets, but really it's going to be one account. But let's say that you already have, and we'll call this the traditional IRA non-deductible contributions. And let's say that you also have $6,000 from last year that's already still in the traditional IRA and whatever, it didn't grow or whatever. And you want to convert just this non-deductible portion over to the Roth side. Well, you have to understand that there's something called the pro rata rule. So that's the pro rata rule. So what this means is that we need to take an equal amount from the deductible and the non-deductible. So you can't just pick and choose or cherry pick just this $6,000 and roll it over. So what you're gonna have to do is, in this case, it's a pro rata amount, so it happens to be the same amount. So for every $1 that you want to convert, you're gonna have to take 50 cents from this top section and then 50 cents from this bottom section, because that would be an equal amount. Now let's say that there was 18,000 up here and there was 6,000 down here. That means 1/4 would have to come from this side and the other 3/4 would come from this 18,000. That is the pro rata rule. So it has to be the same ratio, is really what I'm trying to make sure that you understand. It's the same ratio of these two types, and that is going to create a taxable event. So this 50 cents over here then gets added to your income. Now, there are other strategies that you can use. For example, you could take that traditional IRA and roll it into a current workplace plan. But the whole reason you're doing the spousal contribution is because your spouse doesn't have earned income, so they don't have an existing plan to roll that traditional IRA money out while you're making that non-deductible contribution. So that is just something to consider or keep in mind, that if you are earning your modified adjusted gross income is over $208,000, you're making the spousal contribution and you're doing it as a non-deductible to convert, then you have to be aware that if your spouse has an existing traditional IRA, you have to be aware that there is the pro rata rule. Now, making that non-deductible contribution is also kind of an accounting nightmare. So you don't want to leave the non-deductible contributions in your traditional IRA and just say, you know what, I'm just going to leave it in there, because you might have some issues later on down the road if you're not keeping track of that difference in those two accounts. Now, you could open up two separate traditional IRAs just for your own accounting purposes, but it starts to make it even more complicated. So not something that you really want to do. If you have a traditional IRA, you want to look into other alternatives to get that money out of there before you make the non-deductible contribution. So it gets a little more complicated. If you have questions on that, I could do future videos to go a little bit more in depth or just to answer your questions. And that is the Spousal Roth IRA. And if you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.